welcome to episode 3 of Stock, Paper, Scissors. I'm Ben, and I am currently staring at a chart that looks like a toddler took a green crayon and went absolutely wild on my screen. And across from me, the person who usually has to talk me down from the ledge, Alex. How are you doing today?
I'm doing well then, but I have to say, after our last conversation about why big tech doesn't always win, I've been looking at my portfolio a bit differently. I'm seeing more noise than usual. It's like everything is moving at once, and I can't find the rhythm, you know?
The noise. That is exactly what we're tackling today. Because, think of it this way. If you're at a concert and everyone is screaming, you can't hear the melody. The stock market is that screaming crowd. Every single day, prices are jumping up, dropping down, twitching. It's chaotic. But today, we're talking about the noise-canceling headphones of trading, the moving average.
I like that. Noise canceling. Because when I look at a raw price chart, my eyes just dart around. It's stressful. So are we talking about just smoothing out the bumps, or is there more to it? Like, is this how we actually find the trend everyone keeps talking about?
Exactly. It's about finding the signal in the static. Look at this chart on my phone for a second. See that blue line cutting right through the middle of all those jagged price bars? That's the 200-day simple moving average, or the SMA. It's basically the vibe check for the entire market. If the price is above that line, the market is generally happy. If it's below, well, things are getting a bit moody.
Wait, slow down a second, Ben. You're getting that excited trader speed in your voice again. Let's break down the SMA. It's just an average of the closing prices over a certain time, right? So the 200-day is just the average of where the stock ended for the last 200 days? That sounds almost too simple to be expert level.
It is simple. That's the beauty. It's like, okay, imagine you're tracking your fitness. Your weight might fluctuate 5 pounds in a day based on how much pizza you had or how much water you drank. That's the noise. But your 30-day moving average, that shows you if your actual health trend is going up or down. In trading, the 200-day SMA is the heavy hitter. It's the institutional line in the sand.
Right, I see. So it filters out the pizza days of the stock market. But I've also heard you mention something called an EMA, the exponential moving average. Is that just a fancier way of saying the same thing, or does it actually change how we see the trend?
The EMA is the SMA's caffeinated younger brother. While the SMA treats every day equally, like day 1 is just as important as day 200. The EMA says, hey, what happened yesterday matters way more than what happened 6 months ago. It hugs the price much closer. It's like, think of a cruise control on a car versus a driver with their foot on the gas. The EMA reacts to the turns in the road way faster.
So the EMA is for the people who are a bit more impatient, or maybe just more focused on the immediate now rather than the big picture. I can see how that would be useful, but also kind of dangerous if you're reacting to every little twitch.
Spot on. If you use a 9-day EMA, you're going to get a lot of signals, but a lot of them will be fake outs. It's like a car alarm that goes off every time a leaf touches the window. But here is the historical kicker, and this is where it gets real. Look at Black Monday in 1987. The S&P 500 actually broke below its 200-day SMA 12 full sessions before the actual crash. The big line was screaming that the trend had failed, but people were too busy looking at the daily noise to notice the structural damage.
12 days. That's an eternity in trading time, if you know what you're looking for. It's like seeing the clouds turn green before a tornado hits. But Ben, I have to ask, if these lines are so powerful, why doesn't everyone just buy when the price is above the line and sell when it's below? There has to be a gotcha here. There always is with you.
You know me too well. Hold on, let me pull up this specific chart from 2020. Okay, here's the gotcha. Moving averages are lagging indicators. They tell you what happened, not necessarily what will happen. They're like a rearview mirror that's slightly foggy. In the COVID crash of 2020, we had a death cross. That's when the 50-day average crosses below the 200-day, and it happened on March 30th. But Alex, do you know when the market actually hit the bottom?
I remember this. It was earlier than that, wasn't it? March 23rd?
Exactly. The death cross, this terrifying sounding signal that usually means run for the hills, actually showed up a week after the recovery had already started. If you sold based purely on that crossover, you would have sold at the absolute worst moment. You would have missed the fastest bounce in history.
Wait, say that again? So the death cross was actually a bear trap? That's wild. It's like the indicator was lagging so far behind the reality of the price action that it became a contrarian signal. That's the aha moment for me. These lines aren't crystal balls. They're more like, context clues.
Context clues. I'm stealing that. It's context. It's the difference between a correction and a crash. If the price drops but bounces off that 200-day line like it's a trampoline, that's a correction in an uptrend. If it cuts through it like a hot knife through butter, that's a change in the story.
Speaking of changing the story, sorry, I just saw a notification on my watch. My sourdough starter is ready. I know. It's a total cliche, but I've become obsessed with the trend of my yeast. If the temperature isn't right, the whole thing just stalls out. It's surprisingly like a sideways market.
Wait, are you comparing market volatility to bread? Actually, don't answer that. But you're right about the sideways thing. That's the most dangerous place for moving averages. When the market has no trend, it's just flat. The moving averages start to flatten out too. The price starts weaving above and below the line like a drunk driver. That's what we call whipsaw. You get a buy signal, then a sell signal, then a buy signal, and your account just gets eaten alive by tiny losses.
That sounds like a nightmare. So what's the golden rule here? If moving averages lag and they can whipsaw you in a flat market, how do we actually use them without going crazy?
Here is the golden rule. Never trade a crossover in a sideways market. You need the slope. Look at the angle of the moving average. If the line is flat, stay away. If the line is sloping up at a 45-degree angle, that's a trend you can trust. It's about the angle, not just the touch.
The angle. So it's not just, is it above or below? It's how hard is it pushing in that direction? I like that. It's more about momentum. I remember a trade I took last year where I saw a golden cross, the 50-day crossing above the 200-day, and I got so excited I jumped in immediately. But the 200-day line was still sloping downwards. The price went up for 2 days and then just collapsed.
We've all been there. My stomach dropped just hearing that. That's because the big ship, the 200-day, hadn't turned around yet. You tried to board a ship that was technically sinking. It's why we look for trend confirmation. We want to see the price above the line, and we want to see that line starting to curl up like a smile.
A vocal smile and a chart smile. You really love your analogies, Ben. But it makes sense. It's about patience. It's about letting the noise settle until the melody becomes clear.
So if someone is using the Hedged app right now, looking at these technical overlays, what's the one thing they should keep in the back of their mind?
The key takeaway? Price is the truth, but the moving average is the context. Don't trade the line, trade the reaction to the line. If the price hits the 50-day and bounces with high volume, that's the market saying this trend is real. Use the averages to tell you where the battleground is, but let the price tell you who's winning.
I think I finally get it. It's like we're not looking for the exact moment something happens, but the confirmation that it's actually happening. It's less about being a psychic and more about being a detective.
Exactly. Your Sherlock Holmes and the 200-day SMA is your magnifying glass. It doesn't find the culprit for you, but it sure makes the clues easier to see. Anyway, I think we've smoothed out the noise for one day. I need to go check if my smart lights are turning red or green based on the afternoon session. I may have an obsession.
You definitely have an obsession, Ben. But hey, it's what makes this fun. This was great. I feel a lot less noisy already.
Glad to hear it. This was episode 3 of Stock, Paper, Scissors. Remember, everything we talk about is for education and fun, never actual financial advice. We're just two friends trying to make sense of the squiggly lines.
And we'll be back next time to dive even deeper into the madness. Until then, keep an eye on those slopes.
See you next time on Stock, Paper, Scissors.